The previous housing market meltdown in 2008 was devastating for many individuals across the country. Numerous families could no longer afford their mortgages. Homes were in foreclosure, and workers were being laid off left and right. Could this happen again? Is it a good time to buy a house right now, or should you wait for a market crash? If home prices continue to rise, this could be your last chance to buy a home. But if home prices fall dramatically, this could be a fantastic opportunity. What does a housing market crash look like, and how can you prepare for it? In this video, you'll learn not just how common and serious a housing crash can be, but also how to prepare for one. Learn how to buy a property that will be an excellent investment as well. Watch the entire video because making an informed selection on your largest purchase could pave the way for a lifetime of financial success. Welcome to Cashflow Canvas, where we teach lessons about investment and money-saving techniques. If you want to make your financial future better, make sure to like this video and subscribe to our channel for the latest updates. A housing market crash is a fast loss in real estate values induced by a variety of factors. Seeing a huge value reduction of what is often the largest asset for many families is difficult to bear, and a drop in home prices can have serious consequences. Net worth can create a sweeping reduction in general expenditure, causing a snowball effect of falling prices in numerous parts of the economy, akin to a stock market crash. There are a variety of circumstances that could spark a severe decline in house prices. Rising interest rates make homes less inexpensive to buy since they play a big role in a home's affordability. A mortgage payment on a monthly basis, just a 1% or 2% increase, can make a significant difference in the monthly payment. Over the last few years, we've seen incredibly low interest rates, which has increased demand for property. But those rates have now risen, making it more difficult for some people to qualify for and afford a mortgage. Higher unemployment, subpar lending practices, giving loans to buyers who aren't qualified, skyrocketing inflation, making everyday expenses nearly unaffordable, or a drop in consumer confidence are all factors that could affect the housing market. It's understandable given that prices have been on the rise since the Great Recession. Many were upside down in their homes, owing more than their homes were worth. This negative equity, combined with job losses and other factors, resulted in an abundance of short sales and foreclosures. These properties flooded the market at once, adding to the steep drop in prices. Crashes of this magnitude are quite rare. In fact, it is the only time they have plummeted significantly in recent history, with the crash bringing historic drops of almost 20%. The Great Recession was unique in that it was driven by the housing market rather than the other way around, as shown by this graph of average home prices. Even though prices fluctuate from year to year, they rarely fall significantly from when home prices peaked in 2007. It took over 6 years, or until late 2013, for prices to regain their all-time highs, which means that if you bought right at the top of the market, you would have been in the red. Other than this exceptional time, house prices have risen gradually year after year for almost 6 years. When prices do fall, they only fluctuate by a few percentage points here and there, and the declines do not continue for long. Prospective house buyers who have yet to purchase their first home are excited at the prospect of a decline in home prices. It would be good to buy a house at the levels seen a few years ago, or even better 10 or 12 years ago, as interest rates increase. You might expect prices to cool as owning a home becomes less affordable. However, our reduced prices are really rising up to be advantageous. Consider two different scenarios and their monthly prices. Putting 5% down on a $500,000 house at 3% interest would result in a monthly payment of principal interest, average taxes, and insurance of $2,825. Let's say you get lucky and housing prices drop by 20%. Prices are now more affordable, so you can get the same exact house that was previously worth $500,000 for just $400,000. In order to realize a 20% discount, you'd have to compare the very top to the very bottom, so perfect timing would be required. Only now in dollars, your interest rate might be as high as 8%. Your mortgage payment is now $3,467 per month. This is an excellent opportunity for a wealthy cash buyer, but is it truly an excellent opportunity for a first-time home buyer? The short answer is that it depends on how long you want to stay. According to famous hedge fund manager Peter Lynch, far more money has been lost by investors in preparing for or anticipating corrections than has been lost in the corrections themselves. Home prices may fall, but that does not mean you have an advantage over someone who bought a year or two ago. 20 or more homeowners who bought a couple of years ago will still be ahead. The average home price in 2020 was 31% lower than it is today. Looking at the trend of home prices, you can see that they usually always climb. Therefore, I was not expecting a never-before-seen decline. However, realistic prices may triple again. While you wait for a 20% reduction in property prices that may or may not occur, buying a home is a long-term investment, so consider future pricing. If you buy now, ask yourself if you'll be happy with that decision in 2, 5, or 10 years, not just 6 months. Certainly drops, and anyone contemplating buying a home should be aware of current events such as huge stock market falls. Rising interest rates combined with rising inflation could indicate a drop in property prices. Because no one knows for certain where things are headed, obsessing over it makes little sense. However, similar to timing the stock market, unless you're a professional investor, this strategy usually doesn't work out. Instead, focus on factors you can control that will drastically increase your chances of your home being an amazing investment when looking for a home away from considering proximity to stores, schools, highways, airports, and attractions, as well as areas that are being improved and expanding outwards by the worst house in the best neighborhood, not to be taken literally, but the point is that appreciation is usually higher for less expensive homes in nice areas because there is more upward potential. Everyone wants to live in a pleasant area, even if they can't afford the biggest house on the block. They don't buy a house because of its new finishes. Purchase a home based on its location, yard, functional design, build quality, and other aspects. These are the factors to consider when contrasted to trendy flooring and light fixtures that will be out of style in a few years. Stick to the lower end of your budget for the first few years and make sure you have enough cash left over for maintenance, repairs, and upkeep. It will not end well if you max out your monthly budget only to discover that the cost of ownership is much greater than you anticipated. Purchase a home with income potential. Consider the rental potential of a mother-in-law suite or an accessory dwelling unit if you ever decide to rent out the entire home. When you move into a new one, rental income receipt from renting out part of your home can be used to offset the mortgage if you want or need it in the future. Select not only a home you like, but that potential buyers will appreciate when and if you decide to sell. Most first-time buyers only keep their home for 2 to 5 years. So stretching your budget in the hopes of finding your forever home is unreasonable. Look at the purchase from a value standpoint and avoid becoming overly emotional. Choose a home based on emotions. Home buying is an exciting process, but don't make a long-term decision based on short-term moves. Whether it's rising mortgage rates or other factors, such as stock market investment, establishing a business, changing jobs, or whatever else, there is never an ideal time to start learning about how the housing market changes from year to year and developing realistic expectations about where it might go. Having your ducks in a row by having enough money to make a buy and viewing the transaction as an investment will maximize your chances of success. As we conclude, I'd like to thank you for watching. I hope you found value in this video and learned something new, and I look forward to seeing you in our future videos. I would deeply value it if you could like this video and subscribe to our channel. Your support will help us to create more valuable content, and we can work together to secure your financial future. What are the key takeaways from this video that you can share in the comment section?